We have a Euro US dollar pair open on this chart. Now what I'm going to show you is an example of a candlestick pattern. So we're on the daily bar, daily chart here. So each one of these bars or candlesticks represents 1 day of trading. So what we're going to look for here is I'm going to show you an example of a pin bar candlestick pattern. So what this is going to mean, if I press F12 on my keyboard, I can go 1 bar at a time and look through history. So you can see we have this really big steep sell-off on the euro. Now what's going to happen next, you'll see a continuing selling until we see this. This candlestick is very interesting. So we had plenty of selling. The bears were in control. They were selling this market until we came to this point in particular. At this point, the market, you'll see it opened at this level and it sold off just like it had in the previous days. But then the reason you see this wick here is because towards the end of the day, the bulls rallied and pushed it back up to where it started. This is exactly what a bullish pin bar looks like. So we had a sell, and at the very end we had rejection. The bulls stepped in and bought this market back up to the point that it came from. So what you'll see is if we go forward, a very nice reversal occurred, and that would have been a great trade based on a bullish pin bar. So that's an example of a candlestick pattern. So the next one we're going to look at, the next one is the idea of support and resistance. Now support and resistance is the idea of supply and demand essentially. What we're saying here is that these are points on the chart where people are buying or selling a thing in the past, and we're going to look to potentially have a similar effect in the future. So if that doesn't make sense, hopefully this will. I'll just demonstrate. What you'll see here is that price was on a bullish move and it came all the way up to this point before pulling back. Now at this level, it strongly bounced off of that point. So what we're going to do with a support and resistance line is we're going to grab a horizontal line from the toolbar and we're going to drag that right to the point where the market reversed. So the market consolidated here for a while before bouncing up. It pulled back, and at this level again the buyers stepped in and pushed the price up again. So now, assuming that we're at about this point, we see the market pull back again. At this point we know that there's demand likely waiting at this level. So we could potentially place a buy trade here based on the previous level of support that held. So this is our support line. Now when we potentially go long here, you'll see it had a nice rally and pushed off of that support level and again pushed higher. So from there we can do another example. Let's another example of support and resistance. You can see when price came up to here once, it was rejected strongly by the sellers. In this case, the sellers had control and pushed the market back down. Again, it came up a second time, and if you were looking to take a sell position here, this is what we call a double top example. So we had a rejection off this level, and when it came back up, it was rejected again. So a sell trade could have been a nice position here. You'll see here it didn't work out so well. In fact, the bulls pushed it so strong that this shows that new demand has stepped into the market. And again, when it pulls back, that previous level that was rejected was actually turned into a level of support now because demand became stronger. Hopefully that makes sense. The idea is that we're looking at supply and demand. When we see price break through a significant level of resistance, in this case, and come back, we're going to potentially look to take buy trades in the direction of the push, thinking that now the bulls will defend this level and treat it as a level of support. So that's just the idea of support and resistance, is essentially drawing lines of supply and demand levels and using them to place trades in the direction that the market tends to want to go at those levels based on the past. So that is support and resistance. Now finally we're going to look at some, let's get to our dollar Swiss trade and let's put it on the daily. Next we're going to look at some moving average trading ideas. Let's take the 20 period moving average, let's make it blue, and we're going to place it onto the chart. You'll see we have a moving average. This is just going to be the moving average or the average of the last 20 bars is what we set it. And quickly, let's add a second moving average. You'll see why in just a second. So this is going to be our 50-period moving average. It's going to be a little bit slower. You'll see price moves a little bit quicker than this one. And you'll see that the blue line, which is our 20-period moving average, is much quicker than our red line, which is our 50 moving average. Now, some people like to use moving averages. There's lots of different ways to use moving averages, but one way that's very popular is the moving average crossover strategy. Now, this is a very simple strategy, and I don't recommend you just use this blindly without at least researching it more, or testing it yourself, or trying it out, or combining it with other indicators or other ways to trade this. But what you'll see here is that when we have a significant cross of the fast period moving average across the slow moving average, it's a signal that the market is potentially changing directions. And some people will try to take a trade in the direction of the cross. So you'll see that the fast moving average moved above the slow moving average, and this was a great signal to go long. You'll see we had a massive rally here, and you would have held this trade until it crossed back over here. So that would have been a great example of a moving average price action based strategy.